Good morning, venture capital. This is Metagame, and today we're asking how one company quietly took over an entire sector of the venture market. One company, one filing, 57% of an entire sector category. If that doesn't make you question every benchmark you've built a thesis on, keep listening, because by the end of this, you will. Here's the setup. SEC Form D, Q1, 2026. Other technology, the category analysts use as their primary proxy for AI and advanced tech investment. 177 deals, $29.1 billion. Looks like a healthy, diversified sector with meaningful deal breadth, right? A $164 million average check size, spread across nearly 200 filings. Robust, active, competitive. Except it isn't any of those things, because one of those 177 deals is xAI Holdings, Palo Alto, $16.6 billion. Remove that single Form D, and the category doesn't just shrink, it collapses. 176 deals, $12.5 billion. Average check size drops to $71 million, less than half. The category you thought you were benchmarking against was a costume. Underneath it, a very different market. That's not a rounding error. That's not noise. That is 57% of an entire sector classification sitting inside a single filing from a single address in Palo Alto. And if your portfolio construction model is calibrated against other technology totals, you don't have a benchmark problem. You have a single name concentration problem, and it might not even be in your portfolio. Let me break this down directly. SEC Form D categories were not built for a world where one company raises $16.6 billion in a single domestic offering slice. Other technology is supposed to be a diverse catch-all, the category for companies that don't fit cleanly into software, hardware, or biotech. It's meant to describe a market. Right now, it describes one company with a footnote attached. When analysts pull other technology totals to understand AI investment trends, they're measuring a $29.1 billion category that is 57% one name. That's not market intelligence. That's a distortion with a spreadsheet wrapped around it. Back to the story. Now zoom out. Because xAI is not the exception, it is the clearest expression of a pattern that runs through the entire quarter. Q1 2026 produced $300 billion in global venture capital. 4 companies, OpenAI, Anthropic, xAI, Waymo, captured 65% of it. 41 deals above $1 billion accounted for $193 billion, or 76% of all SEC-tracked capital in the quarter. 4 of the 5 largest venture rounds ever recorded closed in Q1 2026. That is not a cyclical spike. That is a structural reset of what a venture round means. The venture market didn't broaden in Q1, it compressed into a 41-deal universe and called it a boom. Here's what makes the xAI distortion particularly sharp. The underlying category didn't just fail to grow, it contracted. Tech xAI ran 176 deals at $12.5 billion in Q1. In Q4 2025, that same category logged 203 deals at $18 billion. Deal count down 13.3%, capital down 30.6%. The headline number went up because one filing dropped $16.6 billion into the denominator. Strip that out, and the picture inverts completely. The sector shrank. The mega round masked the contraction. That is the hollowing out thesis in its most legible numerical form. Geography tells the same story. California posted $20.9 billion in other technology this quarter, 71.8% of the national category total. Dominant, commanding. Except California's $20.9 billion is almost entirely one Palo Alto address. Strip xAI and California's other technology falls to approximately $4.3 billion. New York at $1.2 billion and Texas at $0.6 billion together represent roughly $1.8 billion of the true xAI base. California minus one filing, still the largest state, but no longer the gravitational force the headline implies. Geography benchmarks broke the same way sector benchmarks did. One company, one city, one Form D, and the entire map distorts around it. Now let's talk about what's happening at the top of the market, because the xAI filing doesn't exist in isolation. The same week that filing came into full view, OpenAI finalized a $10 billion enterprise deployment joint venture with TPG, Brookfield, Advent, and Bain. Think about the architecture of that move. Frontier Labs aren't just absorbing giant fundraising rounds anymore. They're building the infrastructure to capture enterprise deployment economics that would otherwise flow to systems integrators, vertical SaaS vendors, and middleware platforms. The addressable capital pool for non-frontier AI companies is compressing from both directions simultaneously. Fewer VC dollars chasing them and fewer enterprise deployment contracts available because the frontier labs are vertically integrating into distribution. Meanwhile, Anthropic repriced from an $800 billion valuation indication to above $900 billion in 15 days. That's a 12.5% reprice in 2 weeks. That cycle speed is only possible when capital is chasing a very small number of perceived winners with no substitutes. When OpenAI closes a $10 billion deployment joint venture with 4 PE firms the same week, Anthropic reprices that fast. This isn't a fundraising cycle, it's a capital annexation, and the fund-level data confirms the direction of travel. Axel raised $5 billion this quarter, with $4 billion earmarked specifically for its Leaders Fund. Large, late-stage checks into a smaller number of larger opportunities. Even the funds are telling you where the game is being played. When a top-tier manager restructures its capital architecture around fewer, bigger bets, the middle of the market doesn't just shrink in headline numbers, it shrinks in competitive attention. So what does this mean if you're not playing in the $10 billion round tier? Here's the competitive framing that matters. When one company is statistically equivalent to the entire sector category, investing in the sector is functionally a decision about whether to invest alongside that company's capital network or not. xAI's round drew in strategic and institutional capital that now has a vested interest in xAI winning. Competitors to xAI in infrastructure, in inference, in data are now competing against a company whose investors have direct incentives to advantage it across portfolio companies, procurement decisions, and market-making moments. That's not a negative judgment. That's capital structure logic. The network effects of a $20 billion round extend well beyond the balance sheet. And then there's the application layer signal that ties this together. SpaceX secured rights to acquire Cursor for $60 billion, with an option structure payable as a $10 billion joint work deal instead. Even at the application layer, strategic buyers with platform-scale capital are setting the pricing ceiling. So here's the positioning question. If 57% of your sector benchmark is one company's round, and that company's strategic peers are setting acquisition prices at $60 billion for application layer tools, which tier of the market are you actually sized to play? The 176 deal middle, Tech X xAI, $71 million average check. Those companies are genuinely building in the technology category. They're not competing for the OpenAI, Anthropic, xAI, Waymo capital, but their valuations, their fundraising timelines, and their competitive positioning are being benchmarked against a $164 million category average that doesn't describe their market. That mispricing gap is real. And it's an opportunity for managers who can read the X megadata accurately, who can separate the signal from the single name distortion and price the middle tier against its actual comparables, not against a benchmark that is 57% one company. The correction isn't optional. It's the difference between an accurate portfolio map and a fictional one. So here's where we close the loop. The hook at the top of this episode was simple. One company, one filing, 57% of a sector. The question underneath it was whether that number should change how you think about every aggregate you use to build a thesis. The answer is yes, unambiguously yes, because the xAI distortion in other technology is not an isolated artifact. It is the sector-level expression of a market-wide pattern. 4 companies, 65% of global VC, 41 deals, 76% of tracked capital, 1 filing, 57% of a category. The venture market in Q1 2026 did not produce broad-based growth. It produced extreme concentration at the top, masked contraction in the middle, and benchmark data that, if you take it at face value, will give you a completely wrong picture of where capital is actually flowing. The number that matters isn't $29.1 billion, it's $12.5 billion. That's the real market. The other $16.6 billion is one company's round. Know which number you're working with, because right now most people are building models on the costume, not the market underneath it. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.